Good morning and welcome to TOI Japan Market Radio. Today is Friday, January 31st, 2026. I'm coming to you from Tokyo with our daily briefing for global investors tracking Japanese equities, currency, and rates. Joining me as always is our portfolio manager focused on Japan macro.
Thanks for having me. Before we dive in, just a quick note for listeners: the Japanese market was closed today for a public holiday. So we won't have live pricing from the Nikkei 225 or Topix, but there's still plenty to discuss on the policy and global backdrop that will matter when Tokyo reopens on Monday.
Absolutely, and we have several developments that carry implications for Japan exposure even without live trading. Let's start with the bigger picture first. Asian markets broadly rallied today on improved sentiment around U.S. trade, and notably the Nikkei hit a one-year high in yesterday's session before the holiday. U.S. futures are also pushing higher as major indices reach new all-time highs. What's driving this optimism and what does it mean for Japan?
The key driver is reduced uncertainty around U.S. trade policy. When tensions ease, even incrementally, it removes a major headwind for Japanese exporters, especially in autos, electronics, and industrial machinery, which are core earnings drivers for the Nikkei and Topix. We're also seeing a classic risk on rotation where foreign investors, who hold a significant portion of Japanese equities, are moving back into higher beta Asian assets. The Nikkei's one-year high reflects that momentum.
And from a currency perspective, does this backdrop support the dollar against the yen?
It does. When U.S. equities are hitting all-time highs and risk sentiment is strong, the dollar tends to benefit from yield differentials and capital flows. That supports dollar-yen, which in turn is positive for Japanese exporters because it reduces yen appreciation pressure and helps when they translate overseas earnings back into yen. So we have a constructive setup for Japanese equities when trading resumes.
What about Japanese government bond yields in this environment?
You'd expect upward pressure on the long end. Global risk on sentiment and higher U.S. yields tend to lift JGB yields, particularly at the 10-year and beyond. That said, the Bank of Japan's policy stance remains the primary anchor, so any move higher would likely be modest unless we see a shift in BOJ guidance. But directionally, the backdrop is for yields to inch up.
Staying with the yen theme, we had some interesting commentary from Japanese officials today. Finance Minister Takaichi publicly cited the benefits of a weak yen, even as the government has been threatening intervention to prevent further depreciation. That seems like mixed messaging. How should investors interpret that?
It's a revealing statement because it exposes the policy tension within the government. On one hand, a weak yen is highly supportive for large-cap exporters, which dominate the Nikkei, because it boosts their competitiveness abroad and inflates yen-translated earnings. On the other hand, yen weakness also imports inflation, which hurts domestic consumers and small businesses. Takaichi's comments suggest the Ministry of Finance may be willing to tolerate continued yen weakness, at least for now, rather than aggressively intervening.
So does that lower the near-term risk of actual currency intervention?
In my view, yes. If the government is publicly acknowledging the upside of a weak yen, it signals they're not in immediate panic mode. That reduces the tail risk of a sudden intervention to prop up the yen. For dollar-yen, that means the currency is likely to remain supported, and we could see further depreciation if U.S. yields stay elevated. Of course, if dollar-yen moves too sharply, say breaching a key psychological level, the intervention rhetoric could return, but for now the signal is tolerance.
And for equity investors, does this change the calculus for Japanese stocks?
It reinforces the positive bias, especially for export-heavy sectors. Autos, electronics, and machinery benefit directly from a weaker yen. However, there's a caveat. If the market had been pricing in the possibility of intervention to support the yen, and that expectation is now reduced, it could limit upside for yen-sensitive stocks because the floor on dollar-yen is less certain. But overall, I'd say it's modestly bullish for the Nikkei and Topix.
What about yields again in this context? Does yen weakness typically correlate with higher JGB yields?
Yes, there's usually a positive correlation. Yen weakness often brings inflation concerns, which can push yields higher as the market prices in potential Bank of Japan policy adjustments down the line. If the BOJ were to signal any shift toward tightening, even just tapering stimulus, that would accelerate the move. So it's something to monitor closely, especially given the current global yield environment.
Meanwhile, we also have some cross-border news that involves Japan, though it's more on the law enforcement side. Hong Kong police arrested 6 individuals in connection with a $330,000 heist that has links to China and Japan. It sounds like a relatively small-scale incident, but does it carry any market implications for Japan?
At that scale, $330,000, the direct market impact is negligible. You're not going to see the Nikkei or Topix move on this, and it won't affect dollar-yen or JGBs. However, it does raise some reputational and regulatory questions, particularly if Japanese entities or nationals are involved in cross-border financial crime. That can lead to enhanced compliance scrutiny for Japanese firms operating in Hong Kong and potentially tighter oversight of trade flows between Japan, China, and Hong Kong.
So more of a governance and operational risk than a market-moving event?
Exactly. If you're a Japanese financial institution or trading company with significant Hong Kong exposure, this kind of incident could prompt internal reviews and possibly some minor reputational pressure. But unless further details emerge that suggest systemic vulnerabilities, it's a law enforcement matter, not a macro story. For most global investors in Japanese equities, it's not something that should change portfolio positioning.
Fair enough. Shifting back to the broader market picture, when Tokyo reopens on Monday, what are the key themes you'll be watching?
3 things. First, follow through on the Nikkei's one-year high. If U.S. markets continue to hold at these elevated levels and risk sentiment stays strong, Japanese equities should extend gains, particularly in export-oriented sectors. Second, dollar-yen direction. If Takeichi's comments are interpreted as dovish on intervention, we could see the yen weaken further, which would be a tailwind for exporters but also worth watching for any sudden policy response. Third, any fresh guidance from the Bank of Japan or economic data. Inflation prints, wage data, or BOJ minutes could shift expectations around policy normalization, which would directly affect JGB yields and indirectly influence equities.
And for global investors who are either holding Japan exposure or considering adding to it, what's the takeaway from today's discussion?
The backdrop is constructive. You have improving global risk sentiment, particularly from U.S. trade optimism, a supportive currency environment for exporters, and policy tolerance for yen weakness. That combination is positive for Japanese equities in the near term. The main risks to watch are any sudden shift in BOJ policy, unexpected intervention in currency markets, or a reversal in global risk appetite. But as of now, the setup favors continued strength when Tokyo reopens.
Great summary. And just to recap for our listeners, Japanese markets were closed today for a holiday, but the global backdrop remains supportive with the Nikkei at a one-year high, dollar-yen holding firm, and risk sentiment broadly positive. Finance Minister Takeichi's comments suggest policy tolerance for yen weakness, which is a near-term positive for exporters, and the cross-border law enforcement news out of Hong Kong appears to have minimal market impact.
That's right. The key themes are risk on globally, yen weakness as a tailwind for exporters, and upward pressure on JGB yields from the global rate environment. Monday's open will be important to see if the momentum holds.
Thank you as always for the insights. If you're following Japan's markets, consider subscribing to TOI Japan Market Radio for daily updates. We'll be back on Monday with full market coverage when Tokyo reopens. Have a great weekend.
Thanks, see you Monday.